You are staring at the daily exchange charts, waiting for a retail breakout, while the largest balance sheets on earth are quietly running a completely different playbook. Every single week, you see headlines about inflation peaking or interest rates normalizing, yet the price of your digital assets remains pinned in a tight, suffocating accumulation range. You feel frustrated because you are playing by the old rules of speculative retail bull markets, expecting a wave of retail buyers to push your portfolio to the moon. But the market you are participating in is no longer driven by retail hype or public exchange order books. While you are watching the day to day noise of retail sentiment, global central banks are executing the largest collateral realignment in a generation. They are not buying assets to trade them on an exchange for a quick profit. They are accumulating structural tier 1 assets because the underlying plumbing of the international monetary system is facing a profound liquidity crisis. If you continue to judge the health of your digital asset portfolio by looking at public exchange order books, you will inevitably wash out right before the systemic transition occurs. It is time to stop watching the news and start auditing the movement of sovereign liquidity. The core reason you feel stuck in this market is that you are using a speculative retail model to evaluate an institutional infrastructure rollout. You have been told that assets rise in value when a crowd of retail investors floods into the market out of fear of missing out. But that model died the moment the global financial system began its migration toward automated, on chain settlement pipelines. Central banks do not care about retail charts, technical indicators, or social media momentum. They operate strictly on the laws of balance sheet mechanics and collateral optimization. Right now, behind the scenes of the global banking system, there is a silent panic occurring over the quality of sovereign debt reserves. The traditional plumbing that has kept international finance alive for 40 years is grinding to a halt because sovereign bonds are no longer functioning as reliable collateral. When central banks start buying physical gold at a pace not seen since the mid 20th century, they are not preparing for a standard economic recession. They are aggressively moving their core reserves out of debt based instruments and into absolute counterparty-free collateral. You are waiting for a retail wave, but the real play is a complete replumbing of sovereign reserves. Think about the last time you bought an asset based on a major news announcement, only to watch the price do absolutely nothing or dump immediately after the headline dropped. You felt cheated because the narrative made perfect sense, but the market refused to react to the reality of the news. The truth is that you are watching the news while the architects of the financial system are watching institutional liquidity velocity. In 2026, news is nothing more than a lagging indicator designed to keep retail capital trapped in public exchange order books, while institutional desks realign their settlement corridors. Central banks are secretly accumulating gold and building private ledger access points because they know the existing debt based clearing networks are mathematically exhausted. They are clearing the tracks for a system where settlement happens instantly and where every single transaction must be backed by liquid, high density collateral. If you are still measuring your timeline by waiting for a single regulatory announcement or a mainstream media report to trigger a price spike, you are completely miscalculating the scale of this transition. The institutions are not waiting for a regulatory green light anymore. They are actively building the physical receivers. Let us break down the exact mechanism of your frustration so you can transcend the retail psychological trap. You look at your portfolio every day and wonder why an asset with massive utility remains suppressed while useless meme tokens experience volatile, speculative pumps. This discrepancy makes you question your thesis and causes emotional fatigue, which is exactly what the accumulation algorithms are programmed to achieve. The high velocity speculative pumps you see in the retail corners of the market are nothing more than synthetic liquidity loops designed to extract capital from impatient traders. Meanwhile, the true institutional rail assets are kept in strict, tightly controlled accumulation corridors. Central banks and tier 1 clearinghouses require an extended period of low volatility to accumulate their target positions without driving the price against their own balance sheets. They are intentionally keeping the public interface quiet while they absorb the spot supply from weary retail sellers. If you sell your position simply because the price has been flat for months, you are literally handing your spot coins over to an institutional market maker who is calculating their timeline in decades, not days. To understand why central banks are secretly hoarding gold, while simultaneously building out digital ledger infrastructure, you have to look at the structural decay of the global clearing layer. For decades, Western commercial banks settled cross border transactions using a complex web of correspondent bank accounts and fiat currency reserves. This system worked perfectly fine when global trade velocity was predictable and sovereign debt was considered completely risk free. But in today's macroeconomic landscape, that old plumbing is completely broken. High interest rates have caused massive unrealized losses on institutional balance sheets, meaning banks can no longer afford to let their capital sit idle in foreign correspondent accounts just to facilitate clearing. This is where the mechanical shift becomes an absolute necessity. Central banks are moving toward a dual asset reserve model where physical gold provides the base layer of uncorrelated collateral, and native digital bridge assets provide the instantaneous settlement velocity. They are buying gold to fortify their balance sheets against a sovereign debt collapse, and they are testing digital ledger protocols to eliminate the costly intermediate banking layers entirely. The market is not broken. Your mental map of the market is broken. You are expecting an old, debt driven financial system to value digital assets using the same metrics it uses to value speculative tech stocks. But these assets are not stocks, and they do not represent equity in a corporation. They are structural utility mechanisms designed to act as friction reducers for global capital flow. When a central bank or a sovereign wealth fund evaluates a digital asset, they are looking strictly at its liquidity density and its ability to settle multi-billion-dollar corridors without moving the spot price. This level of institutional utility cannot coexist with highly volatile, retail-driven price spikes. The system requires stability, predictability, and deep liquidity pools before it can be trusted with sovereign treasury migration. The suppression you feel is actually the sound of the foundation being poured. The largest capital allocators on earth are locking up the public spot supply into private custody solutions, ensuring that when the switch is flipped, the liquidity is concentrated exactly where they control it. Reset your expectations right now, or the market will force a reset on you. The transition we are witnessing across the global financial system can be perfectly understood through a simple mechanical comparison. For the past 100 years, international trade has relied on the equivalent of packing individual pieces of cargo into separate wooden crates, loading them onto horse-drawn carts, and manually verifying the manifest at every single provincial border. This legacy process creates massive friction. Every time capital moves across a sovereign line today, it must be broken down into individual message strings, passed through multiple intermediate correspondent banks, and manually cleared over several days. This inefficient setup traps trillions of dollars in transactional limbo and leaves commercial balance sheets highly exposed to counterparty risk. Central banks are buying physical gold because they need an absolute unleveraged anchor while they completely dismantle this obsolete wooden crate infrastructure. They are preparing to replace it with a highly automated standardized container system where value moves in sealed digital units instantly across a singular global network. If you are tracking the daily price movements on public retail exchanges, you are missing the construction of this new global shipping lane entirely. When global trade shifted to standardized steel shipping containers in the mid 20th century, it did not change the actual goods being bought and sold, but it revolutionized the velocity of the entire global economy. The cost of loading a ship plummeted, transit times dropped by weeks, and unprecedented economic growth was unlocked simply by removing mechanical friction. This is exactly what is happening to global capital pools right now behind the closed doors of international clearinghouses. The current system of correspondent banking relies on trillions of dollars sitting completely idle in foreign accounts just to guarantee that cross-border payments do not fail. This is the financial equivalent of leaving ships rotting in a harbor because the docks are too inefficient to process the cargo. Central banks are buying up gold reserves to backstop their domestic balance sheets because they know this idle capital model is entirely unsustainable in a high-yield environment. They are shifting to a digital container protocol where capital is never locked up, never idle, and settles completely in under 3 seconds. You are waiting for the price of your digital assets to rise based on retail adoption, but retail adoption is just the paint on the side of the container. The real value is the structural integrity of the steel container itself. The financial institutions are not building these networks so retail investors can trade back and forth. They are building a frictionless cryptographic hull capable of carrying the entire multi-trillion-dollar weight of sovereign debt, private credit, and international trade settlement. When you look at the sluggish price action on public charts, you are seeing the temporary friction of the old wooden crate system grinding against the new steel architecture. The institutional market makers are deliberately keeping the public interfaces quiet because they cannot allow a volatile, retail driven price spike to disrupt the precise calibration of these new capital corridors. They require deep, highly predictable liquidity pools to test the automated routing mechanisms before the legacy plumbing is disconnected. The fundamental mistake of the retail trader is believing that the old system will slowly evolve into the new system through a series of minor upgrades. You expect the traditional commercial banks to simply build better front end applications while keeping the underlying correspondent banking networks alive. But you cannot turn a wooden crate into a steel shipping container by adding a coat of paint and a digital lock. The legacy clearing systems are built on debt, trust, and human verification, whereas the incoming architecture is built on absolute mathematical finality. Reset your timeline and adapt to the new infrastructure layout. To truly understand how this structural shift will ignite, we must examine the friction points hidden deep within the shadow banking sector. The modern financial system does not run on actual cash. It runs entirely on the constant rehypothecation of collateral. When a non-bank financial institution wants to secure short-term funding, it must pledge high-quality assets like government bonds to clear the transaction. But the moment those bonds become volatile due to rising sovereign risk, the entire plumbing begins to lock up because the gears are clogged with unreliable paper. This is the mechanical reality where the traditional financial system grinds to a halt. Central banks are not hoarding gold because they are sentimental. They are doing it because they need an absolute, uncorrelated asset that can act as a flawless lubricant when the debt-driven collateral chains snap. They are preparing a parallel system where value is cleared not through layers of trusted promises, but through immediate cryptographic validation. Think of the current international payment infrastructure as an enormous set of rusty iron gears trying to move a massive weight without any lubricant. Every single time a cross-border transaction attempts to pass through the correspondent banking layers, it creates immense friction in the form of compliance delays, capital drag, and intermediate fees. This operational friction acts like sand thrown directly into the engine of global commerce. The central bank gold rush represents the urgent accumulation of defensive reserve ballast, while their simultaneous integration of public ledger systems represents the deployment of a brand new frictionless engine. They are building an infrastructure where capital flows smoothly across an automated ledger that settles in seconds. The fundamental disconnect between retail speculation and institutional engineering lies entirely in the understanding of collateral velocity. Retail looks at an asset and asks how much fiat currency someone else will pay for it tomorrow on a public exchange. An institutional risk officer looks at an asset and asks how quickly it can be mobilized to extinguish a multi-billion-dollar liability during a liquidity crunch. Government bonds, which used to be the gold standard of financial lubrication, are failing to move with the necessary velocity because their underlying value is tied to inflating sovereign debt loops. This is why central banks are secretly replumbing the system from the ground up. They require a native asset that possesses immediate finality, zero counterparty risk, and the ability to be routed through automated smart contracts without relying on a legacy clearinghouse. You are waiting for a speculative price pump to validate your investment timeline, while the architects of the international monetary system are completely rewriting the definition of systemic liquidity. When a central bank buys gold, it is removing a highly liquid, uncorrelated asset from the open market and placing it permanently into deep, inactive storage. This creates a structural deficit of top-tier collateral in the open market, forcing commercial banks to look for alternative, high-efficiency digital mechanisms to handle their daily operational clearing requirements. The quiet deployment of single-asset liquidity protocols on public ledgers is the direct answer to this collateral deficit. The institutions are building automated pooling systems that can maximize the transactional capacity of every single digital token in circulation, ensuring that global trade can continue to clear even as the traditional bond markets dry up. Stop watching the retail order books and focus entirely on the movement of this institutional collateral. The true phase of structural repricing begins when the system encounters what institutional risk desks refer to as a liquidity vacuum. In the legacy financial system, liquidity is an illusion maintained by market makers who quote continuous bids and asks based on a steady, predictable flow of fiat currency. But when a systemic pivot occurs and top tier assets are pulled off public exchanges into private sovereign reserves, that public liquidity vanishes almost instantly. This is the exact mechanism that central banks are anticipating as they accelerate their private gold accumulation. They are intentionally draining the public float of absolute collateral, leaving the public retail markets highly exposed to sudden, violent supply shocks. When the institutional clearing corridors are officially activated, the lack of available spot supply will force a rapid adjustment of the asset's underlying value. To understand the mechanical blueprint of the XLS-80 protocol and permissioned liquidity networks, you must look at how institutional capital protects itself from public market manipulation. Big banks and corporate treasuries cannot afford to source their operational settlement assets from fragmented retail exchanges. They require isolated, permission liquidity pools where slippage is mathematically minimized and counterparty identity is strictly verified. These private institutional liquidity networks operate completely independently of the public order books that retail traders monitor on a daily basis. While you are watching the flat price action on a standard retail charting interface, billions of dollars in sovereign capital are being routed through these automated permissioned corridors. The public spot price is kept compressed because the actual transactional volume is locked inside these private ledger layers. The repricing of necessity is a fundamental law of monetary economics that retail investors completely fail to comprehend. In a speculative market, assets are priced based on desire, hype, and the willingness of a greater fool to buy the asset at a higher price on the open market. But in an institutional utility architecture, assets are priced strictly based on the cost of the systemic friction they eliminate. If a native digital bridge token can settle a $10 billion cross-border payment instantly for a fraction of a cent, the utility value of that token becomes absolute. The institutions do not buy the asset because they want to trade it for a profit. They buy it because they are legally and operationally mandated to use it as a friction reducer. This shift from speculative desire to operational necessity is what triggers the ultimate liquidity vacuum. Let us look closely at how permissioned ledger environments alter the velocity of institutional capital. In a standard public network, every transaction must compete for block space with speculative retail transfers, leading to unpredictable fees and network congestion during periods of high market activity. This unpredictability is completely unacceptable for a central bank or a global clearinghouse handling sovereign settlement. By deploying private permission liquidity channels running alongside advanced bridging protocols, institutions can isolate their transactional flow from public network noise. They are creating a high-speed financial highway where sovereign collateral can be digitized, mobilized, and settled without ever touching the public retail interface. If you are waiting for a retail wave to drive up the price, you are missing the fact that the entire institutional highway is being built completely around you. The final phase of this macro transition is what sovereign risk analysts call systemic absorption. This occurs when the alternative on-chain financial plumbing stops being an experimental fallback and becomes the primary mechanism for global asset pricing. Central banks are not just hoarding gold to hold a static store of value in a vault. They are preparing their internal ledgers to reprice physical reserves directly against digitized sovereign obligations. When the traditional paper debt markets finally exhaust their runway, the entire global financial system will adapt. The liquid spot supply of native bridge assets will be swallowed up by the automated balancing engines of the central banks, rendering standard retail exchange pricing completely irrelevant. If you are trying to trade for a quick fiat profit, you are blind to the fact that the concept of fiat pricing is dissolving. Let us trace the path of the upcoming mathematical repricing to understand why the final shift will be instantaneous rather than gradual. In a traditional market expansion, value accrues slowly as public awareness grows, and retail buyers gradually bid up the price over months of trading activity. But a systemic liquidity transition forced by central banks operates on a completely different mechanical law. The repricing occurs overnight through a series of legal and programmatic adjustments to the core clearing protocols without warning. The moment a regional clearing agency or a central bank digital currency corridor officially links its liquidity routing architecture to a public ledger asset, the network must immediately establish a deep, highly stable valuation floor to prevent transactional failure. The price is not bid up by emotional retail buyers. It is structurally reset by automated institutional algorithms to ensure the network possesses the necessary capital depth to move trillions of dollars in daily trade volume smoothly. The execution roadmap for this final deployment phase is governed entirely by the laws of network utility and systemic survival. While the retail public is wasting its energy arguing over daily regulatory updates, the engineers of the international monetary system are quietly running continuous security sandboxes. They are verifying the precise operational capacity of the on chain smart contracts to handle massive, high velocity capital flows without experiencing network latency or consensus errors. The secret gold accumulation by global central banks acts as the ultimate strategic insurance policy. It provides the necessary balance sheet insulation to keep the legacy banking infrastructure stable, while the new automated digital receivers are permanently bolted into the international clearing layer. Think about the sheer scale of the private credit markets preparing to migrate. We are talking about tens of trillions of dollars in corporate supply chain financing, international trade invoices, and cross border commercial bank settlements that must be cleared every single day. The legacy correspondent banking networks simply do not possess the balance sheet efficiency to sustain this volume. The incoming asset backed ledger system is the only viable container capable of absorbing this massive wave of institutional transactional volume without collapsing. Stop judging your financial future by looking at manipulated public charts. Lock your position directly into the mechanical inevitability of the sovereign pivot.